So let's talk about the news in the ETF world this week, and that is research affiliates filing for the Research Affiliates Deletions ETF. This is exciting because, of course, you license out your indexes, but this is your first official ETF. Why this one for number one?
Well, firstly, we've partnered with many major asset management firms. When it comes to a niche area, often the majors will embrace an idea after it's had a proven track record. And this is just a really neat niche idea that we wanted to bring to market. So I had to wait 70 years to partner with ETF architects to launch an ETF based on deletions. What could be better than buying the rejects?
Well, I've kind of been thinking about it. So, of course, the rationale here is that you'll buy companies that were recently deleted from major indexes. I've kind of been thinking about it in the same sort of brushstrokes as a fallen angels credit ETF, just in the equity world. Why does that make sense? What about it makes that actually a profitable investment to make?
We wrote a paper back in 2018, buying high and selling low with index funds. And we pointed out that while index funds are really boring, the way they decide what stocks to add and what stocks to drop is not at all boring. The stocks that are added are frothy, beloved companies on a surge, performing brilliantly, trading at lofty multiples. Some of these go on to be the next Tesla or NVIDIA. Others turn out to be bits of frothy popularity that just don't deliver the goods. And so there's a lot of rotation, a lot of flip-flops. On the flip side, those replace stocks that are deeply out of favor, that are fallen angels, that have been crushed in the marketplace, typically down over 50% in the last year before they're dropped. And those companies tend to be liquidated from the index at less than half the market multiple. Well, if you buy the deeply out of favor, unloved companies, what you find is that they outperform the market by about 5% per annum compounded over the last 30 years. Well, that's enough to make 71 times your money in 33 years. That's not bad. And so we've been playing this in our own portfolios for a while now, and we decided, why don't we make this available? This is going to be fun. It'll be a completion strategy. I was just talking with Dave Nadig, and he made the observation that what you're really doing is creating a smart completion strategy that picks up on companies that aren't in the indexes anymore. Therefore, you're completing the package, but you're excluding companies that are likely value traps, and you're focusing on the ones that are recently, newly out of favor, unloved, and deeply cheap.
How long does this outperformance that you cited last for? How long do you intend to hold on to these rejects before you then cycle out of them?
We find that over the first 5 years, they tend to beat the market by 5% a year. After that, they tend to continue to beat the market by diminishing amounts. Now, there's a liquidity issue. Let's suppose you want to buy stocks that drop out of the top 500. That's going to be 20 stocks in any given year. Not a lot of diversification. These are thin, illiquid stocks. There's a capacity issue. If you hold it for 5 years and you take the stocks that drop out of the top 500 or out of the top 1,000, those stocks, now you're looking at a portfolio of 150 names, even after you filter out the ones that are really, really deep quality issues.
So 5 years and then they get the boot, essentially?
They get the boot after 5 years, or if they re-enter the index.
So this strategy, when a stock gets a higher weighting in an index or enters the S&P, it's because active loves it. They're buying it, making the market cap go up, and then the S&P is like, okay, it's big enough to come into our index. And then if it goes out of the index, it's because active is dumping it, right, and shrinking its market cap. So if you're buying these deletions, aren't you buying the stuff active hates? And do they hate it for a reason?
They always hate it for a reason. And some of these companies go on to achieve great failure.
Great failure.
But all they have to do is exceed bleak expectations to rebound handily. The index, if you go back historically, wins just about half the time. But when it loses in any given year, it lags by 5%. When it wins in any given year, it wins by about 18%. I love asymmetries. Investment management success is predicated on asymmetries, and that's a biggie.
And let me ask you about small caps, because talk about an unloved space, just in general. I suppose you're trying to get them when they're mid caps before they get even more rejected into small cap land.
A lot of these are small cap by the time they're...
But do small caps, are they ever going to really take over and sort of run the market for an extended period of time? It seems to be all head faked for the past 15 years.
Oh, I think it's all head fakes for the last 40 years. If you looked at the Fama French value factor, small cap versus large, not value factor, size factor, small cap versus large cap, it peaked in 1983. It's never achieved that peak since. But when it rebounds, it can rebound enormously. And when it is, most ETFs are launched when they're in a space that's frothy and popular. That's the way to make sales. If you launch an ETF in an area that is deeply out of favor, unloved and dirt cheap, it may not catch attention, but the possibility of it having a stupendous first 10 years is tremendous. So I love the idea, as a lifelong contrarian, I love the idea of introducing a strategy when it's at near record cheapness.
Rob, I loved what Katie said about fallen angels and how this is the equity equivalent of fallen angels. Are you kind of surprised that there wasn't something like this made already, given that it's a fairly straightforward concept?
A lot of our ideas, I'm endlessly surprised, are ones that haven't been tapped. This is one that we could just as easily have launched 20 years ago or 30 years ago. A lot of research went into it, but the research wasn't so much, does this idea work? We knew it would work. It's how do we make this scalable? And the way to make it scalable is to bring the turnover down, to bring the number of companies up, and the way to do that is to buy when they fall out of the top 500, buy when they fall out of the top 1,000, and buy them in a large enough number, holding it long enough that your turnover is nice and low.
So that's interesting, and just to sort of crystallize that point, so you could have launched it 20 years ago, but is it safe to say that the reason you're launching it now is because you've solved for some of those problems, how to make it scalable?
We have solved for all of those problems, and so it is scalable. It has large capacity. You've got 150 names. A lot of them are thinly traded, small. But if you've got 150 names and you put 10 million in each of them, that's $1.5 billion right there. So that becomes very easy.
And that is so interesting because we talk to a lot of first-time issuers on this show, and the show is called ETF IQ, so we view the world through a very ETF lens, but it's really interesting to hear that perspective about what finally brought you to the table.
I also find it interesting that it's an index. Everything's active now, it seems like, even themes and smart beta. We talked earlier about when you index something, you're creating a robot. It does what you program it to do, and it removes emotion.
Exactly.
You find that to be a positive, yet a lot of ETFs coming out are active, which are going to have wiggle room and emotion baked in them. Is that why you did that?
I've always believed in stripping emotion out of the decision process.
I'm still working on that one.
I think we all are. How do you see this ETF fitting into someone's portfolio? Is it kind of an overlay onto the most basic index fund, or?
Well, firstly, it's not available today. Mark your calendar. It's available Tuesday.
When it comes out?
So if you mark your calendar and take a look, that's when it's possible to trade it. But be that as it may, the way to fit this into the portfolio is if you like the idea of buying rejects, buying what's unloved. Great, this is the vehicle for that. If you like the idea of a completion strategy that fills in what the index funds that you own don't have, that's a role for it. If you like deep value and you like small cap because they're both severely out of favor, as a replacement for Russell 2000 value, this is a wonderful way to play small cap value in a fashion that leaves out most of the likely value traps and has a chance to participate in outsized returns.
Rob, 30 seconds, there's a producer in my ear, but is this a one-off, or should we be on the lookout for more research affiliate ETFs?
Oh, we're always working on interesting ideas.
Okay.
So we can talk again in a few months.
Okay, so watch this space. Rob, so enjoyed this. Really great to see you in person. That, of course, is Rob Arnott of Research Affiliates.